Sunday, September 29th. I went with the platinum band and the silver ring. Don't sleep on silver. It's a beautiful, beautiful piece of jewelry, okay? Don't only go with the gold and the diamonds. Silver is a gorgeous metal as well. If you remember, the start of this month, what was it? We're going to look at the data. So off the top of my head, we were down more than 2% on the first day of the month of September. And people were saying, there it is, seasonal weakness, Q3 volatility, risk off ahead of the election. What have we done since then? Whew. The Fed has cut rates for us. Markets have remained bullish. Unemployment is stagnating, which is what you want to see. The growth trade is back on. Stimulus out of China. KKR is launching some stuff in the alternative investment world, and baby, guns are blazing. But before we get too far ahead of ourselves, we have to dig in and look at the data. As always, look down below if you want to see the timestamps or the content covered in this video. If you want to skip around, by all means. And if you'd like to get into further detail about any of these topics, find me on LinkedIn or Twitter or email. And I'm not shy about giving out my phone number either. If you want to cut through I don't want to swear, but if you want to cut through the noise, just give me a call. All right, let's get into it. As always, a lot of bear market doomsday sayers out there. So let's look. This is a chart from Charlie Bilello. In the first 182 trading days, this data goes back 1928 to 2024. This year, up 19.6%, is the 17th best year in that period of time. You can see 1929, when there was the Great Depression, we were up a full 28.9% before giving up 31.7%. And that was famously, of course, the Great Depression. Is the market now similar to then? It's a stretch. This also happened in 1987. We were up 28.2%. And then 87, famously, Black Monday, one of the worst one-day performances in markets of all time. Very historic stuff. Is the market today similar to 1987? I think it's a stretch. Pretty much across the board, other than that, we're green when we have this much strength. Okay, so think about where you're putting your money if that's the bet you're making. Okay, let's jam through some other stuff from the great Wayne Whaley. S&P performance after the current 6 months. So the past 6 months being down for a month, then up, 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 up. Kind of like doing a cheat code on like the old Nintendo controllers. When this happens, pretty consistently, we are green the next 12 months. 27 times green, 2 times that we were down. Average percent change up 12.81%. Median percent change 11.5%. Historic average 9%. Okay, so the max drawdowns here, you can see some drawdowns of 10% or higher to get to that point, but by and large, we do well for the next 12 months when we are in this type of price pattern movement of strength. We talked about this just a moment ago. Days, or I should say months, in which the first day of the month has a drawdown of 2% or larger. Generally, we do pretty well the rest of the month. Seems a little bit counterintuitive there, but we just had this again, down 2.1% to start September, and it looks like we're going to finish up. We'll see how that how we finish with the trading close tomorrow, end of the month, end of the quarter, but we are up so far, a couple of percent or more. Now, when the Fed cuts rates, okay, these black lines here being the first cut, it is typically this blue line being where you see okay, so this is the Fed funds target is in blue, but these blue bars here is the year-over-year earnings per share. So you can see earnings per share starts to tail off. The cut happens, Fed funds rates comes down, and it's in response to the fact that revenues are down, profits are down, earnings per share being down. Not the case this time. Look, earnings per share is coming up. You can see it right there. Earnings per share trending in the right direction. More revenue, more profit. Profit margin expansion, revenues up, earnings up, okay? With this coming down, this is a tailwind. This is not one of those situations when markets, the wheels start to fall off. It's the opposite, all right? Hate to break it to you, bears. Q4 data in the year of a presidential cycle. This is here, so not always that we're in a presidential cycle like we are here in 2024, but just in general, in Q4, when we were higher 8 of the first 9 months of the year, by and large, we tend to do pretty well. We're green every single time in this data steady. Okay, hate to break to the bears there. Just tough out here for the bears. The fourth quarter is here. S&P 500 index average quarterly returns from 1950 to 2023. Oof, not a lot of data reads in favor of the Bears here. This one, 80% of the time higher with an average of 4.3%. But here's one, okay? Seasonality for the past 26 years. October, typically not such a good month. We are only up higher 17% of the time. Okay, so October specifically is when we could see some weakness. You tend to see some weakness in September. You start to bottom in October. We famously saw that in 2022. Oh, goodness. Maybe we do see some weakness here. And if the dust starts to settle, we have a fair election, whatever. Don't want to get into the politics of that, but if the transfer of power is smooth and, you know, the wind may be at our backs, but let's see how October does because everything looks pretty bullish. Maybe October, not so much, and then we go higher thereafter. Okay, here's one. One for the Bears. October, specifically, so not Q4, but October specifically tends to be weak in election years. Okay, so here's the election year. This dark blue read tend to be down. Good to know because if we can get a good entry for some long positions, November and December start to look pretty good. Maybe a good time to put some volatility hedges on or get some protective puts if you're heavily concentrated in some single stock positions like Apple, Microsoft, Nvidia could be relatively straightforward to try and protect those. But October, I keep hearing October, maybe not so good. Well, my friend Bitcoin would beg to differ. Look at October here. Average of being up 22.9%, median of 27.2. Shoo, baby. October, they call it. November, average 46.8. December, not too bad, 5.5. January, not too bad, 3.25. Then 15.5, 13.5, 13%. Shoo. Man, we could have a nice finally this halving cycle starting to get priced in. We usually have this frustrating pain trade sideways forever. If we make a new all-time high here in October, oh boys, we are going to be off to the races. Let's go. But okay, let's not get too far ahead of ourselves here. But that looks exciting. On markets, China unleashing some major stimulus. They have allowed central banks to decrease the amount in capital reserves that they need to have on hand. And where did they go and put it? Looks like a lot of it seemed to flow into Chinese equities. And that's not all they're doing. There's going to be more stimulus, more things are announced. I just saw a couple of things just a moment ago. This is from about a week ago now. Every time I look, there's more action being taken. They did also famously do a lot of stimulus and take a lot of measures in 2008, and you guys probably remember that as a global financial crisis. If you're making the bet that now is similar to then Godspeed. But in the short term, extra liquidity is not a bad thing. KKR, I talked about this one a moment ago. This 4.6 billion ascendant fund targeting the large and fragmented the middle market. This is going to be interesting. And I'm going to have to do a separate video all about KKR strategies and what they're looking at in terms of compound annual growth rate projections across different alternative assets and private equity instruments. It's going to be interesting. They're well positioned to do this type of thing. Let's just see how much success they can have because they've certainly got a lot of money to throw around. $4.6 billion fund dedicated to investing in middle market businesses in North America. Launched in 2022 as part of KKR's America's private equity platform. Okay, the first vehicle solely focused on opportunities in the middle market. All right, so what are they going to be looking at? Maybe up to like 50 million in top line annual revenues. Should be interesting. I'm sure there's a lot of opportunity there. There's been some guys that are handcuffed that are waiting for good deals or good offers to be made to look at exit planning. Let's see. Strong response we have received from our fundraising effort and believe that Ascendant is well positioned to address the robust and attractive opportunities in the North American middle market. I don't doubt it. It's really just going to come down to whether or not they can execute. So this will be one to keep an eye on. And like I said, I will do a deep dive. There's about 60 or 70 charts and graphs that KKR published recently from their proprietary desk. A lot of interesting stuff, a lot of ramifications, not just for KKR, but even guys like us in family office world and discretionary capital world, what we can do to manage ultra high net worth client portfolios and get them positioned with good sleeves in all different sorts of private and alternative asset classes. And here's one too. Not necessarily on everybody's radar, but if you have somebody who manages your money, this is something that you should think about because mergers and acquisitions also happen among investment advisors. Okay, Omaha Registered Investment Advisor has added 2 teams from Securities America and bought the practice of one of its affiliated advisors. This might have happened and you wouldn't even have known it. The thing that you need to be aware of is you have a relationship with your individual advisor, but if he goes under different management and they start giving him different products that they want him to sell, oops, I forgot to be logged in. But you get the point. Okay, so a $3.1 billion firm revealed on Friday. It has agreed to purchase $360 million wealth management group and $275 million, a different one, insurance services. Okay, so the point I was just making a second ago, if they start offering different annuities or different types of insurance products to you, you know, you just got to be careful. You got to be diligent and keep an eye on who is the ownership group of your advisory practice. Okay, something worth keeping an eye on because incentive structures ultimately dictate a lot of different things that go on in the financial services industry, and the incentive structure is not always aligned to get you optimum, maximum return, maximum outperformance, and maximum efficiency. Okay, so just something to keep in mind. I don't try to make too many sales pitches here on YouTube. I just kind of, riff around, do my bit of bantering. But if you'd ever like a second set of eyes, I always offer complimentary analysis to people. I want to see people do well. And, complimentary analysis, give me a phone call. I never mind having a good old chat. Seems a little bit counterintuitive that the total money market fund assets increased in a week when the federal funds rate decreased. The Fed cuts rates, you would think risk on, right? Well, so many people have been told that a rate cut is actually bearish that a lot of people decided that they wanted to build their cash position. Not dissimilar to what Warren Buffett has been doing, for example. That so far has not been the right move, as we've actually seen a lot of asset classes performing quite well after the rate cut. But building a cash position, from a wealth manager's perspective, is never a bad idea. I'm curious what advice they were going on or what they're rotating into, what they're rotating out of. It'll just take more time to figure out the strategy there. Meanwhile, we looked at the stimulus headline from China. We know that the debt is likely to be monetized here in the West, and global liquidity conditions right on schedule with the typical cycles, ticking up, up. And there are some plays we're aware of. Fans of the channel, people who follow my work, know that there are some pure plays on global liquidity that tend to perform well. Because, what do we always say? Central banks do not cut rates out of the goodness of their heart. Typically, it is in response to something. So you can see liquidity conditions getting looser, the amount of monetary supply in the system increasing, while corporate profits can actually be decreasing or unemployment could actually be increasing. So, in a situation like that, what do you want to get into? Well, what's the obvious one would be gold. I just looked at Bitcoin a second ago and looked at how we call it Uptober. I like Bitcoin as a more pure play on tracking liquidity conditions and the amount of monetary supply in the system. But gold has been on a ripper. They're looking at 2750 for December 2024, so by year end, 2850 into March and June, 2900 about a year out. So getting to about 3000 a year from now, another 10% or so upside, 10-12%. And hey, never a bad thing to get into the precious metals in the type of environment that we have between inflationary risk, macroeconomic risk, recession risk, geopolitical stuff. Never a bad idea. But always important over time that you want to have an optimized compound annual growth rate. Okay, since 1970, obviously the S&P 500, by far and away the best asset to get into. Gold, for example, or treasury bonds like the TLT position. Position is the right word. These are position trades. You get in and you get out strategically, whereas being in the S&P 500 over the course of time is generally always what you want to do. However, What is missing from here conveniently is our alternatives. So let's take a look. If you're a high net worth fella, you can see this is getting higher and higher. High net worth individuals allocation to alternatives almost at 10% now. And guys, what are you doing? This should be 100%. If you're still one of these guys in a 60-40 traditional portfolio, or if you're still over concentrated with exposure to your own business, the risk you're taking on, is vast, is monumental. Once you get to a certain level of money or net worth, you have to think about delta. How much does it move the needle to double your money from 100 million to 200 million versus if you go from 100 million to 50 million, if you get cut in half? Obviously, having 50 million bucks, you're not going to get wiped out. But the guys I work with, it becomes much more important to be able to protect their assets, to secure the generational wealth, and to be able to establish, build your legacy, and be able to transfer that down to your heirs or your beneficiaries or donate it. There's a lot of estate planning, tax planning, restructuring of your business entities that you should be looking at. And how can you make up the difference? Because you're going to be spending some money and paying for insurance and doing some other stuff. Well, you have to outperform. How do you outperform? You got to get into the asset classes that do outperform. The expected compound annual growth rate. This is from KKR, by the way. I mentioned this a moment ago. KKR released about 60, 70 different graphs that are pretty interesting. I'm going to go through it at some point. But here, venture capital, you can't just spray and pray anymore because, in fact, I have it here. Startup failure has been off the charts. Phew. You can't just spray and pray anymore. But venture capital as an asset class, still a phenomenal thing. We still are in the US of A, baby. Rock, flag, and eagle. Entrepreneurialism still gets the job done. Just make sure you have somebody finding the right project. Private equity, another good opportunity, being up about 13%, not a bad thing. Private debt, private credit, beautiful stuff in the alternative fixed income world. Infrastructure, 13%. I always say this to people, if you like Bitcoin mining, if you like data centers, if you like this AI revolution, we need to power it. Our power grid is going to need double or triple the amount of input to be able to function for the amount of consumption that is going to be happening, not just in America, but China, India, these other emerging markets and other parts of the developed world where we're using more, we're consuming more. So we need to produce more. So infrastructure, not just a good compound annual growth rate, but also there's tax advantages for a lot of stuff in the infrastructural world. So, hey, worth thinking about, worth doing something about. I always like to bring that up anytime I get the chance. And family offices, you can see here fixed income, 18%. This is not treasuries, but most likely in some type of private credit or shadow banking type offerings where they're getting probably 10 or 15% yield and keeping about 10 or 12% cash equivalent. So we're looking at like a 70-30, but an aggressive 70-30 because only 28% is in public equities. A lot going on elsewhere. Art, commodities, real estate fund of funds, real estate direct, private equity fund, fund of funds, secondaries, private equity direct, hedge funds. Shoo boy. I'm interested to see the growth rate and the portfolio performance out here, but we've had some good years, I'll tell you that. I can talk about my own performance, and I'm happy about it. Anyways, think about what is in your portfolio, what it's doing for you, how it is performing, what your tax rate looks like, what would happen in the event of financial system apocalypse or zombies. Stuff worth thinking about, okay? Asset protection is crucial in the high net worth demographic, all right? I just said this a second ago about electricity generation and the energy consumption. Look at China, man. From down there in the 80s up to there. Meanwhile, we're pretty flat here in the United States, but still up. Nearly a double from about 85 to now, nearly a double. And we're probably going to double and triple from here, to say nothing of India or other parts of the developed world or emerging markets. Energy, man. Electrical utility infrastructure is such an obvious theme. So it helps to see that visual, eh? Now, this comes up every once in a while where we talk about sovereign risk and tail risk hedging. And the obvious retort is that is never going to happen. Hey, same way I have a term insurance policy, I'm not planning on dying. But if I did, my wife could pay off our mortgage. Low probability event, still something I can prepare for and use my insurance product in a way that I can flip it, 1035 exchange or other type of way to put that toward another policy that is helpful to me. Okay. Now, what is the point? Asheville, North Carolina, cut off from the outside world due to historic flooding, only accessible by air at this time. I like to say to people, what is your strategy if this were to happen? And they're like, well, I don't know. We'll see what happens. Da, 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 da. And I'm like, okay, imagine something way worse than this. How much cash do you have in your wallet? People are like, I don't know, 20 bucks. Okay, good. How much money do you have in the bank? 10 million. Okay. In this scenario, you now have $20. Your 10 million is gone. The internet's out. The central banks have been co-opted. You can't log in. You have no Wi-Fi. You got 20 bucks now. What are you doing? It's not just a thought experiment. Stuff like this can happen, and preparing for it is not impossible. You could have digital security. Think about things like Starlink that get you onto the internet in a jam. Powerful stuff. Wouldn't you want to have access to it in a jam? How about if you could get your assets into a foreign bank account or a foreign brokerage? Might be nice, right? Wouldn't be the worst thing in the world, right? It's still your money. It's just held somewhere else. We're gonna talk about that in a second. There are also places like in the United Arab Emirates, if you buy a piece of property for about $570,000 US currency, you become a resident there. You get residency status. Not the worst thing in the world if they start saying, hey, you know what, we're not too happy with the US. Elsewhere in the world they're saying this. And you can't get on a flight, but you have this residency status in the Middle East, maybe that allows some strings to be pulled on your behalf, plus you got money in a different bank account in a different country, suddenly you're a little bit more secure. Not the worst thing in the world to do. And I'm not saying everybody has $570,000 laying around, but the point is that you could look into doing stuff like this. You're not throwing the money away. These assets appreciate just like any other assets. Don't you want to have assets that have an additional benefits to them? Things that are worth thinking about. Now, what was I just going to show you a moment ago? We like the United Arab Emirates as a play with that real estate. Well, Singapore, number one safest city in the world, taxes capped at 23%, capital gains at 0%, amazing wealth culture, billionaires walk around in flip-flops. You know what else they have in Singapore? Banks with 100% of the cash in the bank as a capital reserve. You could bank run the place and you're not going to bankrupt them. Okay, now let's just do this really quick just to like give you guys an idea. Put this on like 2x speed and let's just jam through it. Because this is the growth of this country, man. Such an awesome place. Okay, so there it is in 1965. What is it looking in 1990? Here comes the infrastructure. And we'll do oh baby, look at it in 2013. Imagine it 10, 11 years later. Singapore is a place that we work with. We have gotten foreign bank accounts and foreign brokerages set up in Singapore. Not the worst place in the world to hold some assets in the event that something, goes a little bit funky. Okay, now what else did we want to look at? Oh, okay, it was probably not the worst idea to have a conversation about political scenarios in a blue sweep or in a red sweep or in a divided house where the Democrats and the progressives get 2 out of 3, or if the Republicans, conservative sides get 2 out of 3. I am not, one of these guys who's freaking out one way or the other, but you do split hairs when you're thinking about compound annual growth rate. If I can get 10% instead of 8%, or I mean, gosh, if I can get 25% instead of 10%, that's worth doing. But even if I can get 1% higher return by tinkering strategically with my portfolio based on these outcomes, that's my job. So I'm not going to go through all this. This is proprietary information from UBS. But what do they think about macroeconomics? What do they think about rates and the access to capital? And what do they think about the equity market impact? Things that are worth thinking about. And speaking of things we're thinking about, in a week where China has bounced back, great stuff out of China the past week. The resiliency of the US market has been something to behold. But who has done the best year to date? This is like my favorite piece of trivia in all of the world markets right now. Argentina, of all the major world indices, leads year to date. What a story. Viva la libertad, carajo! It speaks for itself, man. If you haven't been paying attention to what's going on in Argentina and the turnaround story that Javier Milei has brought, whew, guys like me in the world of private enterprise who say things like, I'm not mad at the government, their incentive structure is bad. I'm not mad at them. That's what they do. But whereas the government's incentive structure is to make more problems, private enterprises' incentive structure is to solve them. So if I have a problem, I want the private market to do it, not the government. Duh. It's like, duh. But you get very few real world examples where it's like that right there, done. The guy who just trimmed all the fat, who balanced the most imbalanced budget in all of the IMF countries inside of 9 weeks, turned it into a surplus. It's not complicated. Deregulate, right? Fire the people that are not productive. I'm sorry, but you know, and make conditions friendly for business. Like what? Okay, I'm not gonna spend too much time here. I'm just gonna say one more time. Viva la libertad, carajo! Last but not least, two stocks that I really like. First, shout out to the homie. I don't know how to say the last name. Wujastic. Was that some type of like Polish? Anyway, the the price eventually just gets too good to ignore. It was up toward $100. It's now pulled back to 30. It looks like it's wanting to find a bottom, and I've been staying away from it, but I start seeing the homies start posting about it, and I might make a position. We'll see. The extremely oversold RSI at 8, the Williams percent range divergence starting to form, the MACD starting to curl, this wedge breakout of volume shelf. There's a lot of fundamental factors. There's a lot of good reasons to like this stock from that perspective. Monster Energy famously is one of the stocks that has outperformed Nvidia over the same time frame. If you look at the data going back there, interesting stuff. Interesting stuff. I am looking at this one with a keen eye. I'll put it that way. And another one, I've been posting about the energy sector on my Twitter. Energy sector seems like such an obvious one. I was very bullish on utilities and real estate coming into this year. I thought we were going to front run the rate cuts and liquidity conditions. Utilities, I've spoken about energy and electrical infrastructure, ad nauseum. And I was right. I was right, certainly about utilities. I'm starting to get the same vibe right now about the energy market. I could be early and we could have this sort of like deleveraging or this deflationary impulse. But I don't know, man. I don't know if we're going to get that 50 handle on a barrel of oil. And if we do, maybe the doomsdayers are right. We go to 40 or 30. But at least now, Oxy, if you can get a better price than Warren Buffett has paid for it, which, hey, there's a feather in your cap. This potential double bottom, I love it when they swing the low. That's that last stop loss hunter. When people think, okay, we're gonna break a stop loss them and then get the move up, the RSI divergence, the Williams percent range. I'm liking Oxy to outperform, but I like the energy sector overall. Uh, okay, so there you go. Two stocks that I like, Celsius and Occidental. I like plenty of other stocks, by the way, but those are just two I'm looking at right now. Alrighty, folks. We'll catch you next time.